I think you could see $200 silver in the next 6 months or so. Sounds lunatic? No. There's many other historical comparisons where other markets have done comparable events with far less fundamental driving factors than silver has right now. And it wouldn't shock me to see silver at some point in the next couple of years during this, what I think is an oncoming crisis, to be $1,000 an ounce. God knows where gold might be at that time. It might be highly likely to be institutionalized as a money unit again.
Michael Oliver reveals gold-silver just broke out versus S&P after 10-year base in November 2024. Stock market topping like 2000-2007 despite Fed cuts. Dollar broke 13-year trend, heading to low 70s. Silver broke out versus gold after 4-year base. Historically reached 6.5% of gold price in 1980, 3.5% in 2011. Only 1.4% now. Predicts $200 silver in 6 months. $1,000 in 2 years based on precedent. Silver miners vastly undervalued will go berserk. His portfolio? SLV calls, AGQ, top silver miners, leaps, juniors. Crisis obvious in 2026. Move just beginning, not ending. Subscribe to Fine Metals for more updates.
Silver is going to lead gold. The top chart is back to 2020. Silver versus gold. You divide an ounce of silver into an ounce of gold, express it as a percent. And back then we were under 1% in early 2020. And it exploded to 1.5% in a matter of a year. That was during that 2020 surge in the monetary metals. Gold went up 40%, silver doubled. So the spread increased. After that, silver, though going up in price mostly, had an erosional backing off on the performance. And it developed a downtrend and also a green horizontal ceiling. It blew through both last month. It's fully broken out of a massive base that goes back to 2021 on that green line, which is the most important one. So not only are the monetary metals now going to beat the S&P, but within the monetary metals, that close in November took out a 1, 2, 3, 4-point trend line, almost flat, across every single rally high in that spread, going back to 2014 rally, in late 2014, its first peak. That is a beautiful trend line. If this were a price chart of ABC stock, and you broke out over that line, and you were looking at the price chart, what would you say? Oh, we have a breakout. I got to buy that thing, okay? This is a fresh breakout. I think in particular, as silver explodes, the silver miners will go absolutely berserk. It's been above and below that level, zigzagging for 10 years. So almost you could say gold's been par to the S&P in terms of performance. Sometimes better, sometimes worse, but net on balance, nobody notices that. And I love that because they notice it later, you know. But anyway, this is a breakout and it indicates something. You're not going up for 2-3 months here. This is going up for a couple of years. And God knows where it's going. But this is a massive base that will have a massive move. Yeah, well, what you're looking at is a spread chart. Meaning I divide an ounce of gold. I use the front month active COMEX future. Right now, that'd be the February 26 contract. December is in delivery, so we rotate to the Feb. So the February gold contract, which right now is 42.40, I think, as we speak. But last month, these are monthly closes you're looking at here, are plotted. What's the price of gold expressed as a percent of the price of the S&P? And you just simply plot those charts every month. Here we go back to 2013, and that was the year in which gold, after the 2011 high, really started to implode in 2013. And naturally, its relative performance to the S&P, this spread chart, was in collapse mode as well. So you could have flipped the coin back in 2015 and bought gold or bought the S&P, and for most of those years, you'd be making money or losing money or making money, nothing, in other words, okay? Beyond all bubbles, and it has been in a topping process. I emphasize process because normally the U.S. stock market does not merely top and go down, okay? It usually spans a year. Look at the 2000.com top. Look at the mortgage crisis top, 2007. There were 2 highs in 2007. It wasn't until second quarter, really third quarter of 2008 before it really started to bleed. So it was laborious. We're getting the same thing now. I think the U.S. stock market is topping. It has been topping since late last year in terms of our momentum metrics. Price chart, of course, kicks in one of these teaser advances where it makes a high, drops, shakes everybody up a bit, and then whoop, goes up, makes a new high, and everybody says, oh my gosh, it was just a bad dream. Okay, it's not. It did that in 2000. It did that in October 2007. And by the way, it occurred in 2007 with a rate cut. In fact, a surprise rate cut. So, and in 2000 top, the Fed cut rates twice. In January of 2001, this is not far off the high in the market before any real price damage had occurred, and it cut rates for 2 solid years, and yet the market imploded. So I don't know why there are so many people out there saying, oh boy, they're going to cut rates. That's merely an indication of panic on their part. And they never want to exhibit that. They always want to act like it's an academic debate. Yes, they're going to cut rates. And they'll probably keep cutting rates for a couple of years now. Maybe even go back to zero again. After all, we've had zero rates in 10 of the last 15 years. So, but this is also going to impact gold. Right? I mean, it's monetary metal. So if you take fiat money and dilute it by more and more and more money and free money in terms of interest rates, the cost of money, the benefactor is gold. Rates, all it is indication that they're pushing the pedal harder to the floor. Okay, they're always pushing the pedal to the floor. Look at an M2 chart. It looks like the Venezuelan stock market, straight off the page. And that means monetary degradation. The more quantity of money you have, cut it out. Okay. Your granddad, when he built a house, cost $4,500. When your father built a house, it cost $45,000. And now the median home price is $450,000. Okay. So over one long human lifetime, what? That is it really the house went up in price, or no, it didn't. Its price went up. Its nominal price. Its real value did not. Or the yen or the euro is some kind of, real value thing. It's just a piece of paper. It's not backed by anything. And people are going to, I think this crisis that we're about to step fully into, and it's begun already. At least people who are astute realize it's begun. Everybody will soon realize once the stock market starts to break that, oh my gosh, what's going on here? And that's when they'll realize that this piece of paper in their pocket is not holding its value. They need to go somewhere where, they can touch it. It's real. It holds its value over thousands of years. And I think that's the kind of crisis we're going to step into and should become bleeding obvious, especially in this coming year. Yeah. When we measure the very long-term momentum metric of the dollar index, now this doesn't express the dollar's true buying power. It expresses its relative value versus other fiats. Okay, so it's like one piece of this versus another piece of this. Okay, pardon me, I didn't use the right word. The dollar index has been in a massive staircase decline since the 1980s. In fact, that one of the charts on that report just shows that. And when people talk about the strong dollar, what are they smoking? I mean, when you stand back and look at the last decades of the dollar index, it's just blob, gets a rally, multi-year rally, blob to another low, rallies to another lower high. It's a decaying process. As the dollar goes, no, it's the decay in money units, period, not just the dollar that drives gold. But actually, look, if you look back at where gold was in December of 2015, it made its bear low at 1,050. It's 4 times that price now, okay? Go back to the dollar index in December of 2015. It was in a rally phase and peaked for a while in the 98 area, right where we are now. So if you draw a line sideways back to 2015, we've gone either side of that number on the dollar index, yet gold is quadrupled. So my argument is the decay in the dollar is important relative to the others, but ultimately gold is driven by ongoing decay in all the paper money units, not just the dollar. To be among the miners should probably be some emphasis on the silver miners. I think they have much more potential percentage gain, and it could be very dramatic. I don't just mean doubling, if you know what I mean. I mean dramatic. So,
Yep.
and it's a tiny little sector. Well, fortunately for silver, the fundamental is that most silver doesn't come from silver mines. It comes from base metal miners who produce silver on the side as a marginal product. Hence, their primary motivation or profit-driven factor is the price of copper or the price of some other base metal, not the price of silver. It doesn't motivate them to mine more copper to get the little bit of silver they get out. So the silver miners are highly focused little beasts that even if they're tiny little guys, and maybe the cost of production at $30 an ounce was not really good for them. Now suddenly we're pushing towards 60. What if suddenly you're 150, especially silver? Now on this page, we show the gold miners going back to 2013 versus S&P. They've also broken out. Then the bottom chart there is silver price divided into S&P going back to 2013. You also had a downtrend. You broke out above it too. So all the monetary metals and their miners just broke out over an 11-year wide performance base. It's just begun. It's not just gold. It's the miners as well. It's silver, monetary metals and their miners. This country, that country, a growing contagion of people saying, hey, this fiat stuff hasn't worked. We've been playing with it for 100 years and it's just created boom busts. Let's go to real money. It takes pain to cause that kind of rethink, but I think that's what we're about to step into. Oh, by the way, that's another place that needs a lot of focus by investors. The commodity category and mining companies that produce fertilizer, et cetera, they're a good place to be.